have Kenny back in the studio. We want to learn more about stocks, options, spreads, all this stuff. So is this option available to buy the spreads through like Robinhood and all these accounts?
Yeah.
Can you tell me some stocks that you typically are okay to do the spread? Because there has to be a lot of volatility, right?
Yeah.
Only then you're going to make money.
Yeah. A common one that people use is for SPY, which is just the SP 500. And it's an index that follows it.
It was interesting when Kenny actually shared his insights on why he has chosen to pull the money and lose the $45,000. It was pretty interesting.
Every spread, the wider the number, the wider the strike prices are, the more your spread will be. So if you did like $100, $99, that $1 difference would cost you $100 of spread.
I have Kenny back in the studio. We want to learn more about stocks, options, spreads, all this stuff. So Kenny, welcome back.
Thank you.
Teach me, what is spreads? I only know butter spread. So I need to know more about these spreads in stocks.
You don't need any butter. You don't need a pot. You don't need a little knife. So when we talk about the world of options, spreads is actually a buy-sell of two different options. And it's a way that you're gambling that the stock's going to move up or down. So for example, you could have a call side credit spread and a put side credit spread. And what happens is it actually works the opposite direction. So if you think the stock is going to go down, you'll sell like a call, a ceiling. And the goal is as the stock goes further and further from that ceiling, this becomes less valuable, which is good for you. You want your spreads to lose value in there. Vice versa, if you think the stock's going to go up, you could sell a put spread. And the put spread would be here, and as the stock goes up, you can make more money from it. And the nice thing about this is what you do is you sell to open and you buy to open. And what that would mean is if we say $100 stock, for example, you might sell the $95 spread, the $95 put, and then you'll buy the $90 put underneath it. So you might make $3 and spend $1. And what happens is as long as the stock finishes above your sell, your short leg in there, then you'll make money. If it falls below it, that's when you start to lose money in here. So it is a way to use less capital up front and more of a one-way bet. And they're risky because if it goes really bad against you, you can lose more money on that. But it's also easier to get into. Instead of needing $1,000, you could buy a spread for $50.
Okay, so why do people don't hear about this? Like, is it like because it's very risky, or people just don't know? Is this option available to buy the spreads through like Robinhood and all these accounts?
Yeah, so it's a pretty common thing when you get in there. Most people want to buy options, and that's a lottery ticket. So that's the people who I've bought one call at $100 stock and the stock's worth $200, I'm a millionaire all of a sudden. So this isn't as common because quite frankly, it's just not as sexy. And like you hear a lot of people on Robinhood, they want to use the Wall Street Bets people. They don't like this. They want to go big or go home. That's not what this is about. This strategy has to be more calculated. Got to be a little bit more patient in there. I'm actually starting to do it on the daily for the SPY or SPX, but some people will do it monthly. The reason a lot of people do actually use this because it can be a little bit more conservative and save your cash in there. You just have to know how to do risk management in case it moves against you, in case you thought it was going to go up and it starts to come down.
I mean, can you tell me some stocks that you typically are okay to do the spread? Because there has to be a lot of volatility, right?
Yeah.
Only then you're going to make money.
Yeah.
So if something is in the news or something.
Yeah, that could very well, or earnings reports, right? That's this time of year, May, April, the month plus after every quarter. That's when things are going to be moving real fast, going up, going down, just because we don't know how your company did. And then when those reports come out, you either beat expectations or you did not beat them. So a common one that people use is for SPY, which is just a SP 500, and it's an index that follows it. So that is probably one of the most traded stocks out there, simply because there's millions of people, and it's a very day trader one. So it's going to behave not erratically. Whereas like a Tesla, you don't know what's going to happen. If some major news comes out, it could spike that thing all of a sudden. It could be a little bit more erratic. So SPY is probably the most common one for day trading and doing spreads on.
Okay. Now, in the other episode, Kenny talked about how not to lose $45,000. So you want to check it out. It was interesting when Kenny actually shared his insights on why he has chosen to pull the money and lose the $45,000. It was pretty interesting. So with the spreads, the money that you make might not be as dramatic, and even the money that you lose might not be as dramatic also.
That depends in there. So every spread, the wider the strike prices are, the more your spread will be. So if you did like $100 and a $99, so that $1 difference would cost you $100 of spread. You might make $15, but you're gambling $100 in there. And so if it drops below 99, you'll get to keep your 15, but you'll lose your full $100 on it. So there is a cap to how much you can lose in there. And that's why one of the reasons why people like them is they know what the risk is going to be as a worst case scenario.
That's great. Kenny, thanks for the information. I want to talk about how we lost about $45,000 in real estate investment. So hang tight for that.